A full deck because there's a lot to talk about today. Begin with the market. Stocks have been volatile yet again following a lighter than expected jobs report. Investors now wondering what it all means for the future path of interest rates. Pete, 700-point comeback yesterday.
Unbelievable.
What was characterized as a Goldilocks jobs report. The market got off to a good start. Here we are down 430. What's going on?
And then suddenly we hear from Peter Navarro, and all of a sudden things start to change a little bit. I mean, I honestly think that there was certain triggers, and that's one of them. Certainly, I think that the market's focused on certain things. And we know that algorithms, and I know I bring it up every day, but algorithms are also focused on specific words that are coming out, not just from the Fed, but politically and everywhere else. That's part of the trigger. And I think that's why you see this accelerated move. We were up and looked pretty strong early on, right? I mean, we're up 100 plus points, and now here we are down 400 points. We're less than 3 hours into the day. I think a lot of that says what's happening in this market. We've talked about uptick rule. We talk about algos. Those are real, and the stability factor is not there because we've removed some of the different catalysts out there that actually could stop this from going down.
So, Steve Leisman, the jobs number called by some light but not necessarily weak, maybe Goldilocks for the economy. You have Mohamed El-Arian saying it's unlikely to postpone December, but could cause a downward revision of the path. Atlanta Fed goes from 3% growth to 2.4% in about 6 weeks. That's not a long period of time that things seem to be coming down.
That was always the forecast, Scott. And somewhere along the line, the markets got up to this high point of an all-time high in the Dow, and it was sort of like being on the top of a mountain, and they were able to look around and say, whoa, wait a second. The next step has to be down from here. And that's where the market is right now. And I can say now about the Fed with a little more certainty, Scott, that what's going to happen is the Fed's going to move to this much more data-dependent world. And they're also, by the way, coming, to a much more market-centric world where they're looking at what's happening.
Right?
Yeah, I mean, we're talking to some people,
talking to people you talk to.
Listening to people saying publicly as well. And here's what's likely to happen in December is that the growth forecasts are likely to come down for the consensus of the Fed, and probably as well the dot plots will come down. And what the Fed, I think, sees is they see, among other things, slower global growth affecting the U.S., as well as tighter financial conditions. You think of stocks being up and down as more money in your pocket, but from an economic standpoint, when stocks go down, money and investments gets more expensive, and that's one of the things the Fed is looking at.
Let's be clear. We're saying that the Fed was already looking for slower growth. Now they're taking, in some respects, their own slower growth forecast and slowing them further.
That's probably likely what's going to happen. And just to put some numbers on it, they were looking for 3 and change this year. They're probably going to get it. They were looking for 2.5 next year, and they're probably going to get less than that. That's the expectation right now.
Okay. Lindsay Bell, how do you see it?
Yeah, I think that's exactly what happened. When third quarter earnings came out, investors and the market in general had to come to this reality that growth next year is going to be slower than what we see this year. We kind of knew it was out there, but we kind of had to face it. Companies were talking about how costs were going up and that would impact their bottom line. And then you started to see cracks in the economic data, too. While this number was kind of a Goldilocks number for the market today with regards to jobs, the question is the uncertainty really around trade and the Fed as we go into 2019. And we're getting mixed messages on both accounts.
This is, Ron, I mean, it's more dovish Fed versus more hawkish trade.
Yep.
And the market seems to not know what to make of it.
Well, this may be too arcane a phrase, but this is the gang that couldn't smoot straight. The 1930s tariffs that were imposed, uniform, thank you very much. But you have Larry Kudlow, the president's top economic advisor, coming on CNBC this morning, talking very optimistically about the outlook for trade, the rapport between the president and President Xi of China, and how we're likely to get a deal. Then, as you know, Peter Navarro, the president's top trade advisor, goes on another network and says it's a 90-day hard cap on our negotiations. So no one knows what's going on the trade front. There are warring factions in the White House that simply cannot square their positions. And this
17 people on the Fed talk with more cohesion about monetary policy than 3 guys in the administration. I think one of the big developments, Scott, is that the administration is losing the confidence of markets on this issue.
Yeah. Josh, you look at tech is down big today. There were some saying, okay, yesterday you have the 700-point comeback. Was that a bottom? Market reacted sort of violently up after it was down for most of the day.
Yeah.
So what do you do?
And that could still happen today. Look, first of all, if you have someone managing your money who's making buy and sell decisions on your behalf based on gossip from the White House of which trade representative is in favor or whatever, fire that person immediately. Let's focus on price instead of gossip. Here's what's actually happening. So many investors fall victim to the recency bias, meaning whatever they're seeing on the screen in front of them colors their thinking about what's about to happen. It's very natural. It's very normal. If you just focus on bigger picture trends and you see a week like last week, up 4.85% for the S&P, it was the best week for the stock market in 7 years. If you just focused on that 5-day period of time and you got all bulled up, well, this week they took half of it away or more. You're now down 3.7% on this week. Broaden that out a little bit. Over the last 9 weeks, you've had 4 of those weeks you've lost more than 3% in the S&P. That's extraordinary. We haven't seen that since the European crisis in September of 2011. So I think you need to take your charts, pull them back. Don't focus on what's going on today, yesterday, and this week. Look at the bigger picture trend. 2,800 on the S&P has been resistant 3 times in the last 6 weeks. Until we're above 2,800, convincingly, there's nothing to talk about.
You know who's looking at the bigger picture trend is a guy like Lee Cooperman, who was on with us yesterday for a long period of time and looks at everything that's happening out there fundamentally and says people are making
fundamentals and price are different, though.
Let's listen to Cooperman and we'll talk about it on the other side.
In my 50 years of doing this, what do I look at? I look at the economy. I look at inflation. I look at monetary policy. I look at valuation. I look at bonds versus stocks. And everything comes up, saying it's a great buying opportunity.
Jimmy, is he right?
I want him to be right. Look, when he looks at value, when he looks at price, and obviously he's a great investor, we know that, right? He sees the opportunity there. When I look at the price and value of many stocks, I say to myself the same thing. It looks great based on future cash flows, future earnings. Here's where my problem is. I'm really concerned about the GM announcement from 2 weeks ago where they're laying off 15,000 people. I know it's just one company, but that doesn't happen in a vacuum. Ford has to follow. The rest of the manufacturing area has to follow unless, here's the positive outcome. You do get a resolution on trade issues because that was the catalyst for the layoffs. But until you get that, I got to say, I'm a little nervous that my projection and Lee's projection of future earnings might be too high.
What's a resolution of the trade issue look like? Because we're talking about a 90-day time frame to solve things that go back to the 1990s.
Listen, I totally agree with you, and that's part
of
what you're implying.
Is a resolution a tweet? Like, let's put some meat on those bones.
What you're implying, it's hard to put meat on those bones, and that's why I'm a little nervous.
Well, look, I think it's safe to say we're in a bear market globally in a lot of different stock markets, China, Germany. I think we're in a stealth bear market here in the United States.
Not even that stealth.
It's not even that stealth.
Bear market since the beginning of the year.
It's stealth in the sense that no one.
44% of the stocks in the S&P are above their 200-day. More than half are below. It's nothing stealth.
Well, it's stealth in the way it's been discussed.
Sure.
Nobody's declared a bear market in stocks. So in the sense that, yes, we've seen a lot of stocks go down more than 10 or 20 or even 30%. This has been a gut-wrenching year. And since January, we had a failed top in September, which is a sign, again, of bear market activity. And it's been going on now for close to 11 months.
What if the Fed is, in fact, easier than people had thought they'd be? Sarat, you go in December. I mean, if the market keeps with this upset, who knows? But let's assume they go in December, which is in a couple of weeks, and then they wait.
Look,
what happens?
I think the offset of that is exactly what you gentlemen here have been talking about. The issue is that nobody can get their arms around future cash flows. And the more we get closer to this 90-day period of uncertainty, you need 2 sides here to agree. This is not just one Fed saying we're going to do something. And if both sides can't agree and we get what, like 3 people are talking, left, right, and center, the short-term investors, your algos, all these people are saying out, out, out. I think for us who are looking at some point, you look at intrinsic value, price to book, you're getting to a point where it was cheap 2 weeks ago, it's getting cheaper now.
But I will say this, multiples have come down since January by a lot. And while there's many reasons for it, one of the big reasons is uncertainty about future profits.
So, Lindsay, is it enough to step in and buy stocks? You listen to Cooperman and you say, I agree that people are making mountains out of molehills. Let's buy some stocks that are cheaper than they were 6 to 8 weeks ago.
Yeah, I mean, I think it's tough to jump in entirely 100% because you look at this morning, you saw upside on the back of the economic data and people sold into it. Look at the action on Monday. People were really excited. They thought we actually had a trade deal with China and we ended the day on the low. So it's very hard to get super bullish and buy right here. Maybe you buy a little bit now.
How many points is the headline, and how many points of the Dow is the headline, Navarro leaving the White House worth?
That's not the question. Is how long does the reaction last?
Yeah.
Well,
You get an hour out of that, or you get a day?
We've mentioned
it's 500 points. Is
We've
my
mentioned
estimate.
Navarro's name a couple
Maybe
of times, and the reason being
500, right? Maybe more than 500.
We hope to actually bring you the sound. In the meantime, I'll tell you what he said. He did an interview on CNN earlier today where he said if there was no agreement during this 90-day moratorium or negotiating period, whatever you want to call it, that we'll move forward with the tariffs. And that seemed to upset the market. Not talked about a lot, but maybe that's one of the contributing factors as to why you went from Goldilocks jobs, market up, to, oh no, trade, market down.
There's two places where the administration does not have the confidence of the markets. The first is on trade. I know what the administration's argument is, and it's that this is a long-term positive for the U.S. economy and for U.S. companies and for U.S. workers. The market has not bought into that. The second thing they have not bought into is this idea that the tax cuts, especially on the corporate side, are changing the DNA of the economy, that we're going to have this uplift to potential growth and allow us to remain up there. Instead, look at what the Fed's forecasting, which is coming back down towards potential of around 2%. Look at what most of the street is forecasting. I'm not saying they're wrong about either one of those things. I'm making the point that they don't have...
Repatriation didn't happen at the scale that they said it would.
And it did not have the effect.
$700 billion.
I'm just saying they don't have the confidence of the market on these issues.
$700 billion is your number?
It's the number I saw this morning.
Versus $3 trillion
total?
No,
I understand that. But what I'm saying is it's a percent of the $3 trillion overseas.
Now, how about CapEx? Would you say that's a fail? I would.
Yeah, I would say it's a fail.
Okay.
How
about...
It's too early to say it's a fail, but so far it's a fail.
Okay, I'm going to make 2 points. Number one is I think that trade is not understood in the proper context in this administration. Bob Lighthizer, Peter Navarro, Steve Bannon all view China as an existential economic and military threat to the United States. That's why this is not easy. It is a regime change. It is a philosophy change.
Like an economic regime change, right?
Absolutely. And then, too, and I'm going to take Pete on a little bit here with respect to the algos and everybody else. When I started in this business, there were guys that used to walk onto the floor with boxes of tickets, and that was called a program trade. And things started to happen a lot faster as the market got computerized. They used contextual analysis and keyword searches the way people used to use rumors and other bits of information.
Sure.
Same reaction, faster, more violent, but still fundamentally driven at the end of the day.
Really? I totally disagree. There's absolutely nothing to do with fundamentals whatsoever. These are algos that are just going off of a word. Literally.
The traders used to go off of
well, maybe they did, but there was actually something there in terms of the fundamental side of it had to be there. It doesn't have to be there now. Quite honestly, it has nothing to do with it. It's just a sell program that goes in a mass way with no uptick rule. And if people,
But you remember when guys in your
business, what baffles me
business-
is this: that nobody understands that when they stopped the uptick in 2007, how that changed the market, how that changed volatility. Yeah, but if you agree with that,
on the uptick rule. But listen, you know this as well as I do.
But this is a crazy thing that everybody doesn't embrace this the proper way.
Back in the day when we were young men, and I stood next to your brother, October 19th, 1987, on the floor of the Chicago Board Options Exchange. In those days, you guys were starting rumors in Chicago, not you specifically, but rumors would start in Chicago. The markets would go absolutely nuts until they unwound those rumors.
And the speed of that rumor was so different than what we're talking about now. Well, that's why it's a completely different animal.
I get it.
I mean,
Wapner, settle this. Wapner, you're the judge. Settle this. Nigerian or Asana? Which one?
Nigerian's right. That's the end of the story.
On many occasions, certainly throughout this trade process, if nothing else, where a positive headline has triggered whatever algorithm or whatever.
And they work to the upside, too. I'm never saying this is just a downward thing.
But the long-term trend is still the long-term trend. This is the same type of noise we used to get when somebody pop a rumor out there, and then you
well, this is why Lee Cooperman yesterday, when he was on here, and I think if you listen to both he and Jamie Dimon, they essentially just sort of said, let's step back and look at what we're seeing in front of us right now. You guys mentioned CapEx, by the way. Part of the reason we don't have those CapEx numbers that we were maybe expecting is they have no visibility. Right. And that changed the game. But that changed the game, right?
I think that's a key point. That's an absolutely key point, because I think there are people in the president's administration who tell him that, Mr. President, what you're giving with this hand, you are taking away with that hand. And what I was told was that for half an hour a day, the president understands that.
Well, Jamie
But for
Dimon yesterday
23
said
and a half hours the rest of the
he
day,
said that uncertainty is
rejects it.
what causes volatility, and it's exactly right. And the uncertainty of the tariffs certainly are part of why you're seeing the volatility in folks that are not willing to go out there with capital.
If I say, Lindsay, the economy is good enough, evidence of the jobs report today, it's not like we're falling out of bed, okay? The economy's good enough. The Fed is going to go in December and then, stay and stand pat and take a look. But we still don't have a resolution for 90 days. Are we saying stocks can't go up in that scenario? I've just painted that scenario, which I think is what we're living in.
Yeah, the market's very sensitive to this trade topic, and I think the point that you were all making is that over the next 90 days, a negotiating period, we have no certainty of where we're going, which means that corporations and executives are really going to put themselves in a wait-and-see mode with regards to investments and hiring, and that is not going to help the stock market. We could be in for a very weak Q1 because of all of this.
We might have seen I think you're right, and I think we might have already seen the beginning of that
Q1 is
with
already
yesterday's ADP and today's.
We got that for the last 3, 4, 5 years.
And today's NFP.
Let's also talk about inventories. Companies don't know what to do with inventory. Do we order in? Do we not worry about
I could
tariffs?
already say that they've ordered. They ordered ahead when they
But that was a
when they thought all this tariff-related stuff was
possible I
happening.
could place an order. And
I'm saying that may have caused some of the elevated GDP numbers.
I'm not quite sure how this works, but I think I can place an order now for something to be delivered from China 90 days from now, and that good could be 15% more expensive when it comes in. I don't know if they grandfather in prior orders, but if they don't, that's the risk I have, right?
But I think the bigger overriding risk is not the fundamentals of companies and orders, because I think a lot of that's going to be sector dependent anyway. There are some companies that just have to order. It's not really discretionary. I think the bigger issue sentiment-wise, and I asked for this chart to be made up because it's the elephant in the room. This seasonally is when we're talking about Santa Claus rallies typically. This is when you'd expect to get that year-end push. Here's my chart. So the line is where we began the year, or where 2017 ended, frankly. It's very rare for the S&P to be negative this late in the year and not be down big. So the optimist would say, well, we got off easy. We're down 0.3% in the S&P. On average, in the 19 years since 1957, when you had a negative S&P this late in the year, on average, you're down 12%. We're flat. So you could say, wow, we had two 10% corrections, separate corrections from all-time highs, and we're flat on the year. We're getting out of this thing easy. The bear would say, well, you got 3 weeks left. Don't count your blessings, because if it's the typical...
Well, there's an old expression, right?
Right.
A bear will come to Broaden Wall if Santa Claus should fail to call.
You do not. So from a sentiment perspective, where is that lift?
That's not a joke.
That you would typically get? And I think to be negative on the first Friday of December, first of all, you might have the first down year since the GFC, which I think is noteworthy. I think it
tell me where my
sentiment.
risk is. Is my risk that things will be much lower from here, or that I'm going to miss a
The risk is in the price of your house.
Where's the bigger risk?
Right.
The risk,
Value of your home,
the risk
frankly.
is our discussion about slower growth is unfortunately the wrong discussion. If the discussion should be about decline in GDP, recessionary layoffs, those sorts of things, then the risk is not a 10% correction. It's a full-on bear market.
But you're putting us in a recession. That's what you're saying.
That's what the risk is.
You're thinking the slowdown. Yeah, but what's the likelihood of that? What's the probability, right?
The
whole idea of what we're trying to do is you take in all the data that you have and you come up with a probability of where, I'm stealing this from Howard Marks, of course, of where you are in the market cycle. You're putting us at the very end of the cycle.
Scott, you and I and everybody on the desk knows the markets look forward. Okay, so we're talking about November's jobs report. That's great. The market is focused on what's going to happen in Q1 and in 2019. And again, I go back to this announcement from GM.
I want to just pipe in. I think the probability of recession is very low here. I don't see it.
Look, 3 months ago, all of us would have been talking, at worst, we have it in 2020. I'm telling you, with all the things, and Lindsay, you're bringing up, CapEx, and how could anybody invest in CapEx? And what do they do about inventory right now? Nobody in corporate America knows what to do right now. Corporate confidence is not good right now. That gets reflected first in reduced hiring and then in layoffs.
I was going to say, CEO confidence on the read today is still at historically high levels, okay?
104.
Let's not act like, CEOs have stopped spending anything and that we're laying off thousands of people everywhere.
They stopped
and that
hiring.
a recession is happening on January 1st of 2019.
How about Challenger Gray says they stopped hiring? Large corporations are done
in the quarter.
Hold on.
Still at you hold on for a second. And confidence is still at a historically high level.
Because you have to break that in half. Small businesses are still hiring like crazy, and there are 7 million open jobs to fill. That's a great climate for Main Street. It's great. And they have bargaining power and wages. However, large corporations have begun mass layoff announcements. Pharmaceuticals, automotive, not just in the U.S., globally. That is something that you could not have said in 16
and there's an expression we used to use
different.
called a growth recession, where growth falls below what we expect, below trend, if it's 1.5 or it's just south of 2.
Well, earnings growth is at risk of doing that.
Exactly.
Some are talking about earnings recession next year. You go from 20+% earnings growth down to 4%.
Half of which was
Stanley's
taxes.
Right.
Yeah.
Look, we talked about Navarro and the comments that he made earlier on CNN, which may have led to part of the market decline. I want you to actually listen to it for yourself now, and we'll continue to discuss it.
If the issues that you mentioned, and Trump has listed here, the sizable trade deficit, stolen technology, et cetera, if they're not resolved in 90 days, is this administration willing to walk away?
It's not a question of walking away. It's a question of moving forward on the strategy, which is to simply raise the tariffs on the $200 billion from 10%, which they are now, to 200%.
Okay, that Jim Sciutto, of course, with Peter Navarro, you don't have the benefit of context or follow-ups or anything like that. But that doesn't seem, Lindsay, to sort of help investor confidence on a day where you may have gotten a jobs number, which would suggest to you, especially after a story was written in the Wall Street Journal yesterday that the Fed was mulling a slower path. You could hang on to that, and you could say the jobs number underscores that, but then this trade thing from Navarro drops into the room.
Yeah, and the question is, we know that we're going into a slower growth environment in 2019. GDP is going to go from about 3% in 2018 to 2.5%. We're going to have earnings growth go from 23% to 7.5% to maybe 5%. And that's typical of late cycle economies, which is absolutely fine. But the thing is about trade is that this could change the picture. It's the wild card. We could go from 3% growth down to 2, 1.5 in GDP. Earnings could be closer to 1%, and that would be a dramatic change.
Jennifer Surratt, you're running your portfolio. I don't know how you deal with the volatility.
Look, I think the way I look at it is these are things that we don't know. And I agree with you guys, this administration.
But you've made a bullish case over the last, times that you've been on.
Yes,
that some stocks have come down far enough to buy.
They are.
I'm suggesting you think that, and then you have a 1,500-point decline over 2 days in the Dow, recovers 700 points yesterday in the afternoon, walk up today, market's up, now it's down 400.
And it is as a short-term, God, I bought this stock 2 weeks ago and now it's down 15%. But when I look at it and I say, if I think my earnings are going to even be on the bottom side of some of these stocks, I'm going to do very well. And that's kind of what I'm looking at. But I'm not trying to get out of the market. I'm not trying to time it. I want to be in high quality, good companies and in areas that I think are misunderstood. And especially if you look at the financials, industrials, cyclicals, those are kind of the opportunities they're trading at below market multiples with higher growth rates.
I just want to make a point here, which is this idea that there's a theory out there that expansions get old and they die of old age. I don't subscribe to that. There's a different way to think about it, which is the economy is going to grow if you don't screw it up, which is to say that expansions die of policy mistakes. We have two policy mistakes on the table here, and I think the right evaluation from an investor standpoint is to evaluate, can each one of those separately and or together lead to a recession? Policy number one is the trade policy. Can they screw up this policy? Okay, I can use that word on cable, right?
Yes.
So badly that it leads to a decline of investment and a recession. And can the Fed, at 2.25%, 0% real, I keep reminding you, are they so high and tight that that's going to lead to a recession?
We seemingly had removed choice B, at least from the highest level of risk.
So that's not going to be a policy mistake.
Well,
maybe that's
what about the first one?
Maybe that's diminishing.
I don't know. Is the first one enough on its own?
Well, how many people, how many investors watching this are experts on international trade, number one? Number two, how many people are aware that the president's lead advisor on trade issues, besides Lighthizer, is someone who wrote a book called Death by China, who literally would like for there to be a war It doesn't have to be a physical war, but at least an economic war, rooting for a war.
Yeah.
So I mean, I don't know if that's a decision that individual investors should be sitting at home thinking they have an edge on that.
Just noticing the president's arrival there and noting it for all of you in Kansas City, where the president's going to deliver a speech in about an hour. Just want to let you all know why we're showing
remember,
that
later
there.
in the day, you're going to see 2 drops of information on Paul Manafort and Michael Cohen that will reveal more, or could reveal more, about the ongoing investigations.
That's just a witch hunt, though.
I understand that, but you know, there's more information coming. The president's been
finding
talking.
witches.
But on trade, though, the other thing, too, is sure, we have Peter Navarro. He's a hardliner. Mike Pence is a hardliner. But then on the other side of it, you have Kudlow and Steve Mnuchin, who are all free traders. So within the administration, you have this argument. And then from our seats right here, again, not, to your point, none of us are experts. So how do we trade on that? How do we make money and invest on that? And that is where the uncertainty is.
Yeah, well, because your head ends up spinning over, you know, Fed versus trade. One seems to fall into your favor, and the other one, just when you think everything's going to be okay, falls out of bed.
When he tweeted that things had gone well with Xi in Argentina, you really didn't get that great of a reaction around the stocks that you would think would, like, Ford Motor is a $9 stock. It went up 29 cents. Yeah. Like, is that the trade?
We were also in the process of having the CFO of a Chinese company arrested while he was talking.
But I'm just saying, is that like what we're trading for?
What about the tariff man tweet? That was worth 400 down in the Dow.
Yeah. You do have to remember this, though. Going into that weekend, the G20, we talked about all that short-term paper, right? So I know you pointed out Ford. I would just say, hey, look at what some of the industrial stocks did in a 2 or 3 day period, because they had a magnificent run to the upside. The XLI was trading, the industrial index, trading around 70 or a little bit less, got up over 72. There was a nice sharp move there in some of the industrial names. It wasn't all the names. It wasn't Ford. It wasn't some of the names that just can't seem to be able to find to fly right. But a lot of these industrial names did move to the upside.
At least 20
had 2 hours to sell them.
Right, but that's the market.
I'm noticing on the tape some comments from Brainerd of the Fed as well. Economic momentum strong as shown by the labor market. She says financial conditions have tightened in recent months. The headline seems to be gradual rate hikes remain appropriate in the near term. What do you make of that?
I think that's what I would expect her to say. I don't think Brainerd wants to be out there leading. I knew she was going to come out. Didn't know she was going to come out during the show. But look, the Fed has a view that the current state of the economy is in good shape, that all of the concern is out there. And we talked earlier about cracks in the economic data.
Bostic yesterday gave you the sort of hint that, you know, they're along the lines of December.
They see a slowing out there. But right now you did 155,000. Let's put that in Federal Reserve context. The way the Federal Reserve sees the jobs market, you need 80 or 100,000 jobs to put people to work who are coming into the workforce. That would keep the unemployment rate unchanged. When you do multiples of 10,000 above that, you are driving down the unemployment rate into new places we have not been in the past.
So who then either leaked the Wall Street Journal story about wait and see, or was that a speculative piece by the Journal yesterday that didn't have any basis in Federal Reserve thinking?
I don't know the answer to that question.
Yeah. It seemed to have an impact, though, on the market, right?
But it didn't say anything that we didn't already know.
No, but anytime you get anything that suggests that, okay, December and then sit back and wait, is going to have a more positive than negative impact on the market, especially when you're down, 780.
I will point out just real quickly, Scott, that we did do 27,000 manufacturing jobs in the month of November. The impact of tariffs on jobs is not there yet. It would be a speculation that's coming.
Yes, it is. Factually, it is. You can't ignore the GM announcement. You just can't.
I'm not ignoring. I'm just saying that 27,000 manufacturing jobs is a very good number for the U.S.
We all know we got to look forward.